Well, thank you very much for coming along to this presentation of our interim results. The format we'll follow will be similar to previous briefings. I'll cover off the headline issues, including the numbers, and Paul will take you through the detailed financials. This should take no more than 20 to 25 minutes, and then we can take your questions. In terms of the key financial points, EBITDA for the period at $324.3 million was 20.9%, or $56.1 million higher than the previous corresponding period. There are always a lot of moving parts in a result, but if you want to summarise it, total generation was up over 6% for the period, with hydro generation being especially strong in the first quarter, and the new wind farms at Mill Creek and Mount Mercer contributing 271 gigawatt hours. In New Zealand, average weekly generation market share for the period was 33.6%. This healthy generation position, combined with higher wholesale and retail sales, the latter reflecting growth in the small business and agribusiness sectors, saw total energy margin improve by 7.5%, while a 10.1% reduction in operating costs also contributed positively to the result. If we eliminate for one-offs, and Paul can comment on specifics, EBITDA improved by over 15%. Operating cash flow at $216.8 million was an improvement of 13.2% and reflected the higher EBITDA, but was partially offset by higher income tax. Underlying NPAT was $114.8 million, up 38.3% on the previous period, again reflecting the improved operating performance. Key market points. It's very pleasing to be here and not telling you about very flat aggregate demand, and it's good to be able to point to some growth over the calendar year to December. Although relatively small at 1.3%, it's important to note that most of this growth occurred in the June to December period, where we saw over 2.9% growth. From our analysis, it would appear that the growth has largely been rural in nature, and previous losses in urban areas and the industrial sector have now halted. So with some luck, we're starting to see the proverbial green shoots, and this just isn't a statistical aberration. Retail competition, as you'd imagine, remains intense, and we saw some very competitive sales activity in the residential segment in a number of networks. These were at effective prices that we would not wish to emulate. While retail loads were up for the period, we did see some reduction in ICP numbers of just over 3,000. But this is now stabilised, and we believe will improve when our new marketing and advertising campaign commences this month. It is common knowledge that the Tiwai Point smelter owner is investigating electricity options running up to the 1st of July this year, when it has the right to give a termination notice. In fact, NZAS recently made statements to the Southland Times to this effect. As you'll be aware, the way the contract is structured, NZAS is highly incentivised to reduce from 572 megawatts to 400 megawatts in January 2017, should it elect to stay. And it's only logical that it would investigate options with other generators. We cannot make any comment on any discussions they may be having, as we do not definitively know who is involved, but of course we can guess. Clearly there are strategic as well as operational issues that NZAS will consider in any decision. But our current assessment is that although aluminium prices have been volatile, they are still better than they were a year ago, and there has been a significant decline in the New Zealand dollar to the US dollar in this period. Both of these factors on our modelling suggest that the smelter is running at a reasonable cash surplus at this point. So on balance, we remain hopeful that a positive decision will be made, and it is heartening to see that NZAS is actively pursuing all alternative options to keep the smelter running at the current levels. I'll comment on our two major regulatory issues later. Suffice to say, they aren't going as quickly as we would like, but I guess that's the nature of the beast. Capital management. As advised at the time of our 2014 results announcement in August last year, the board has over the last 6 months been considering whether it was appropriate to progressively return capital to shareholders. The company's financial results continue to be in line with expectations, and other than the continual monitoring of inflows into the company's storage lakes, there are currently no operational issues that impact the board's views in a negative manner. The balance sheet remains strong, with gearing and resulting ratio levels at a level that allow prudent re-gearing over time, while still remaining within the Standard & Poor's ratio range for our existing BBB+ rating. Demand for capital in the foreseeable future, whether to fund stay in business or attractive growth projects, looks to be limited. Furthermore, the risk of wholesale change to the electricity market structure has reduced considerably following the election. So in these circumstances, the board believes it appropriate to positively consider the progressive return of capital in excess of requirements to shareholders. The initial change is a formal amendment to the company's dividend policy, which was actually passed yesterday, which will see the dividend range as a percentage of free cash flow, as defined in the policy itself, increased from an average of 70 to 80% to an average of 75 to 90%. Furthermore, subject to, and I emphasise the words subject to, New Zealand Aluminium Smelters not exercising its option on 1 July to terminate its electricity agreement, any material event or some unforeseen attractive growth opportunity occurring, the board intends to progressively return $625 million to shareholders over the next 5 years. After canvassing a number of shareholders, including the Crown, as to their individual preferences, and looking to balance the interests of all shareholders, it is the board's current preference to either adopt annual on-market buyback programs or to declare special dividends or a combination of both. Clearly, any buyback program would be dependent on the board being of the view that the program could be achieved at prices that are fair and reasonable to both the company and its shareholders. An announcement on the capital program for FY16 will be made at the time of the full results announcement in August, and is subject to the board's right to suspend, cancel or modify any proposed program should there be any material adverse event, sustained poor trading period, or should some currently unforeseen capital requirement become obvious, whether that be growth or stay in business related expenditure. So hopefully you are noting the caveats. The dividend. In line with the new dividend policy, the board has declared a dividend of 4.8 cents per share, which is fully imputed. This is approximately 4% higher than the dividend forecast in the prospectus for this period. The board has also decided to declare a special dividend of 1.4 cents per share. The reason for this being the remaining imputation credits held at the time of the final payment of the instalment receipt in May would otherwise be forfeited under the current New Zealand tax legislation. This dividend will also be fully imputed. The record date for both dividends will be 31st of March, with the payment on the 15th of April. Regulatory issues. This is an industry that will always have regulatory issues, and at this point we have two major issues. The first is getting a satisfactory outcome to the Electricity Authority's transmission pricing review, and the second being the Australian Government's review of the renewable energy target. With respect to the transmission pricing review, initial paper on options is due out any day, with a final issues paper due in June, although I do understand that that might be under review. While progress has been slow, we acknowledge the need to ensure due process has been followed, and we remain confident that any option that is progressed will address the key issue of HVDC charging. We also believe that such a solution will be far more equitable and ensure better price signals for future generation projects, while also being better for consumers. In Australia, the Abbott government's review, or lack of review, of the RET scheme remains stalled, the government being unable to implement anything without garnering the support of opposition parties. This state of uncertainty has now prevailed for 6 months since the review panel released its report and has brought the renewable energy business in Australia to a virtual standstill. We had previously advised that if there was a materially adverse change to the scheme, Meridian may need to review the carrying value of its assets in Australia. Unfortunately, the lack of any clarity at the half year leaves us none the wiser as to what the future may look like and unable to form a view on an appropriate carrying value for those assets, whether that view be positive or negative. In terms of our projects, I think there are 2 key points to take. The first, we've completed the last of our new project builds for some time and have done so within our original budgets. And I can confirm our view that there are unlikely to be any new projects for some time, either in New Zealand or Australia. And we won't be going to Chile, by the way. That said, we still continue working to ensure our current development options are ready for deployment should we be blindsided by any growth in demand. But clearly, on current assumptions, investment expenditure, which for this period was $106.5 million, in all likelihood is going to continue to decline for some time to come. Second point, we continue to manage our stay-in-business CapEx within the range indicated to investors at the time of the IPO at around about $65 million or less per annum, even with unplanned expenditure such as the replacement of the 3 transformers at Manapuri, which we've had to deal with this year. And incidentally, the last 2 of those transformers are currently being unloaded at Doubtful Sound as we speak. PowerShop Australia. PowerShop now has over 30,000 customers in Victoria as at the end of January and is maintaining steady growth in a very competitive market. With its position as the greenest retailer in Australia, the brand positioning appeals to a wide audience, and market testing in New South Wales has indicated good levels of interest in that state. So with a relatively low marginal cost of entry, it makes sense for us to extend the operations to New South Wales, and this will occur in late February, early March. The push into New South Wales was not budgeted for this year, and the entry will incur additional marketing costs, but these have all been allowed for in our forecasts. The push into Australia obviously has the advantage for PowerShop in New Zealand of developing its knowledge of what is required to support other markets and regulatory regimes from an IT development perspective. New Zealand retail. We'd previously announced the sale of our metering business ARC to a subsidiary of Vector in December last year. It is pleasing to note that this transition has gone very smoothly, and we anticipate this delivering better efficiencies and lower costs over the years to come. In addition, we've commenced the rollout of the replacement of all legacy meters, with the pilot nearly complete and the ramp-up due to start in March, with 7 new networks being added. I've already commented on the small fall in ICP numbers that we have seen stabilise since Christmas, and with the new marketing campaign that I mentioned, we're confident that we'll be able to address this reduction in the months to come. We most certainly will be reluctant to follow pricing down. And with that, I'll hand over to Paul, and he can talk a little bit more on the pricing issues and then explain the financials in some detail.
Thanks, Mark. So before I get on to the financials, just talk a little bit more around the retail position. Mark's already talked about demand and the lift we're experiencing at the moment. Most of this in the last 6 months, and we've seen the numbers now for January, and the trend has continued into January. There are three main factors behind the uplift. The first of those is continued strong growth in provincial New Zealand. And although we did see high irrigation loads towards the end of the period, which gave this an extra boost, the underlying growth is definitely still there. Secondly, the slight decline in urban demand that we've seen in the last few years has halted and even slightly reversed, with distinct growth showing in both Auckland and Christchurch. And lastly, we haven't seen the closure or downsizing of a major industrial user in the period, which impacted on prior periods, particularly from the pulp and paper industry. We do need to be cautious in just how much we draw from 1 year's numbers, and we certainly don't expect a return to the historical levels of demand growth, but the change is still an encouraging one. With firming demand and the reduced take-or-pay obligations on thermal generators, we've seen a noticeable rise in forward ASX pricing. And these prices form one of the reference points for commercial and industrial pricing. So a lift in new commercial and industrial contract rates may arrive a little sooner than we'd anticipated. That said, the market is still in a situation of oversupply and competition remains pretty brutal. This means that residential and small business customers are likely to get some very attractive deals for some time yet. And this has been further emphasised by the entry of 7 new electricity retailers to the market in 2014. Meridian won't be making network-wide energy price changes in April when line charge changes come into effect. We will, of course, be passing on changes in lines costs to customers, meaning that some networks will likely see reduced top-line prices. Outside the one-off switching incentives, and some very large ones that some competitors are offering, Meridian sits at or around the lowest price in most major networks. This is the result of no network-wide price increase since 2012 or 2011 in respect of some networks, including our largest, Orion. This obviously has a negative relative financial impact on us, but it's not a position that's easy to address in the current cutthroat environment. On the plus side, it does mean that our customer base is more resistant to aggressive competitor offers, and that's showing in our retention stats, and also if you look at our segmental numbers in how our overall residential pricing is held up. Moving on to the financials, I'll take you through some of the highlights, but obviously there's a lot more detailed analysis you can find in the appendices to this presentation, including breakdown of energy margin, key funding metrics, and other things. If you see anything that's missing, do let us know. As you will have gathered, all the major financial measures have moved in the right direction. These results have benefited from a number of one-off positives. So the removal of last year's IPO costs of just over 8 million, and the receipt of final insurance monies relating to the Christchurch earthquakes, a bit over 5, both of those improving EBITDAF. And then below the line, profit on the sale of the ARC metering business and the remaining, nearly all the remaining farms that aren't required for development or operational purposes. However, even if you strip these out, the improvement in the numbers is pretty pleasing. If you look at our EBITDAF on a like-for-like basis, as Mark said, we're up 15.4%. That's 42.9 million on the same period last year. Energy margin in New Zealand lifted by 20 million compared to the prior comparative half. This included nearly 11 million of increased wholesale sales of derivative contracts on the back of strong generation, and around 8 million from growth in retail volumes in the small, medium enterprise and agribusiness segments. We also benefited from a lower cost of acquired hedges compared to last year, when we had a significant number of HVDC outages which we needed to cover while the full control system commissioning on Pole 3 was carried out. With the completion of Mount Mercer and growth in Power Shop in Victoria, Australian energy margin grew by a little under 14 million. Now, there are obviously some costs associated with this growth, and I'll cover operating costs in more detail in a moment, but overall our operating costs were down on the first half of FY14. Below EBITDAF, there were some increase in interest costs as project interest capitalisation came to an end, and as you'd expect, a lift in depreciation relating to the new wind farms. However, even taking this into account and increased tax, as Mark said, underlying NPAT was up a healthy 38.3%. All this translated into a 13.2% improvement in operating cash flows. And in terms of how that was spent, the period saw the last remaining spend on Mill Creek and Mount Mercer. And if you offset the proceeds of assets sold in the period, net investment spend was 67.1 million, down nearly 95 million on the same period last year. And we expect the second half, obviously, to be lower still. Of course, stay in business CapEx has to continue. And in this half, we spent 23.9 million. This is well within the 65 million per annum average expected spend that we include in our dividend policy. Moving on to costs, we do split out transmission costs given their size, and there was a brief respite this year in HVDC costs as the final capital cost of the Pole 3 project came through and firmed up. That's not going to last. I was just looking at the graph before I came down here, and we expect that to go up again next year, and Transpower have already indicated that. Look, hopefully a more sustainable charging mechanism will emerge before Mark and I actually register for our gold cards, but I wouldn't count on it. As I mentioned before, operating costs have seen pressure from the new wind farms and Australian retail growth, so it's good to be able to report that we've been able to absorb those costs and make further savings through the continued drive for efficiency and sort of smarter ways of doing business. I'll now pass you back to Mark to wrap up before your questions.
Thanks, Paul. So in summary, it's been a very satisfactory half year for Meridian, with a number of factors leading to the lift in earnings and our ability to enhance dividend returns to investors over the forecasts in the prospectus. Looking at the balance of the year, we are mindful that a lot of the country is still in drought conditions, but we have been getting regular, albeit small, inflows into our catchments. And as at yesterday, Lake Pukaki storage was 93% of average. So at this point, our fuel position is not adversely affecting our generation outlook for the balance of the year. And as a final comment, although it is not our process, it is the Crown's, we'd like to remind our shareholders that the final instalment is due under the instalment receipt structure by 15 May. And shareholders can expect initial communications from the Crown on this in early April. So with that, I'm going to conclude the formal part of the proceedings and ask for questions. Now what we will do here, we'll take questions from the floor initially, and could you please wait to get a microphone before you ask the question so our viewers can participate in the question as well, and then we will ask our viewers for questions. Queries?
Good morning, guys. Thanks. Great result. Nice to see. First question was just around how you tracked in the first half relative to what your expectations were in the PFI, and I guess a sort of a follow-on question is, are you able to update us on, I know you don't provide formal guidance, but just some sort of indication for where you expect the full year to go?
I'll leave the PFI comment to Paul, and then I'll comment on the guidance.
Well, look, we've tracked reasonably well. We're not putting those numbers in because we've got our own split, but that wasn't part of the PFI documentation. But our full year position is sort of, we're not giving guidance. We're not in a position where we need to give guidance.
So remember, Andrew, that we have a PFI number out there, and we have analyst consensus, and if you go back to what we said at the ASM in October, which we have carefully looked at, we don't think we need to say any more. It would be inappropriate for us to make a comment, so perhaps you should dig that out and have a look at it.
Okay, and then the next question I had was just around the operating costs, and we're seeing those coming down nicely. And if you're able to give us an idea of the permanence of those cost savings that we've seen, and whether you expect further savings, I guess, in the second half and beyond.
Paul, do you want to?
Yeah, I mean, there is continued pressure. I don't expect a big slug, sort of, but it's continuously grating and continuously trying to improve stuff. Why are we going into the metering rollout? It's because we think that it's got cost advantages as well as customer benefits. It's that sort of thing that's now going to yield cost savings rather than large-scale redundancies or anything of that nature.
I mean, I think I mentioned the phrase before, Andrew. I mean, it's really now like a battle of inches. So, I mean, when we have people leave, I mean, we'll be continually reviewing whether we need to replace that role. But, I mean, it's not as if we have some major restructuring in our bag. It's just a continual grind down of those costs and getting better efficiency out of our retail operations. It's the core of our focus in that area.
Okay, and just the final question from me was just around dividends and the imputation that we're seeing on that. So we've got a fully imputed dividend, I think, for the first time.
Yeah.
And again, that wasn't, I think you were forecasting the PFI to have something less than that. And obviously the profitability's had a big impact on that. I don't know if you have any comments about what we can expect going forward. Are you forecasting fully imputed dividends going forward?
The PFI didn't sort of take into account the discontinuity event. That was the sort of fundamental there. What you've got to remember, or what you've got to understand, is that our tax payments, because of our provisional taxes, are weighted up the front end. So that gave us a little bit of additional sort of room to move. So I would expect not to see the same thing reproduced in the second half. But I wouldn't be surprised if we were at or around the PFI levels in that second half. So I think, you know, what you've seen last year, this year, if we can maintain results, we can get a reasonable level of imputation. But I don't expect us to be at 100%.
Congratulations on your capital management initiatives. I think well consulted and well communicated, and no surprises, which is good. Just a follow-up question to Andrew. If you go down the special dividend route, that's an extra 5 cents per share, and you add that to the underlying, and it means you're potentially paying out kind of 200% of earnings, along with sort of accelerated tax depreciation and Aussie earnings. Should we be probably thinking imputation levels well below 50%? So does that sort of suggest you're more going to go down the buyback route, or how are you thinking?
We're not going to make any decision between the two, Jason, until we see where, obviously for the first program in FY16, where the share price is in July. So it's going to be a decision which is going to depend on the relative merits of each alternative at that point. I mean, clearly, if the share price is right at the top end of expectations, it would be a little bit difficult for us to execute a program at that point, and in which case we would pay special dividends at whatever level of imputation. Tax has to be paid somewhere.
Exactly. I mean, it's tricky, but I mean, would you rather pay a bit of tax or have the money? It's
and just a quick one on Power Shop, the retail in Australia. Is that cash break even at the moment?
It depends on how you look at it. If you strip out the costs of acquisition, we're in that sort of region, but you're constantly spending money to get in growth. Yeah. So if we chose to stop here, we'd be at around that place, but we're not choosing to stop here.
Cool. Thank you.
Any other queries from the floor before we throw it open?
Just on the Australian retail, what is the natural size that you see you could potentially grow that business to, and also on the New Zealand market, if you were going to have some capacity come free over the next few years, how would you look to address your retail book? Would you look to increase the retail book in the Meridian or in the Power Shop, and how would it play out?
Well, I think, I mean, in terms of Australia, we're not there to stay at current levels. I mean, we would like to see it at least achieve a material level of earnings, which, I mean, we would like to think over a period of time will be something, 20 to $25 million EBITDA. So I won't say, what number of, customers that implies, but we're not there to obviously sit at 30,000. We like to think, obviously, that we can get to north of 100,000 customers in a relatively short period of time. And you've got to remember, I mean, as has been noted by most of the other retailers, I mean, growth in New Zealand is rather limited, and growth in generation is going to be rather limited in Australia as well for some time, given the climate of uncertainty that's been created by the by the Abbott government and the relatively low levels of demand. But PowerShop is a different product, and we're prepared to just keep soldiering on, which we are doing, and continually acquiring customers. In terms of New Zealand, what was the main point of your question?
Well, the point that you were going to be selling less to New Zealand aluminium smelters.
Yep.
Would you look to grow your retail book?
Well,
and if you would, how?
I think we've made that comment before. I mean, if New Zealand aluminium smelters, there's a couple of alternatives. One is that they just give us back the 172, which is highly likely. I mean, we have alternatives at that point. I mean, most of you know we have the Genesis swaption, which covers us for a dry period. We pay a sum of money for that. And if we get that 172 back, we might be able to look at releasing that swaption. So that reduces a cost for us, and we could sell that excess generation into the spot market, which would be a net benefit for us. So we see getting the 172 megawatts back as being a real positive for us, and we see some real incentives for some of the other players to step up and do some of the heavy lifting on that 172 megawatts when they consider their position against the counterfactual of them going. In a case of TY going in its entirety, then you've got your nuclear situation, if you like. And what happens at that point is going to be dependent on how some of the thermals look at their supply into the market, their marginal costs, and whether they want to stay in operation. So there might be some supply side changes. And I mean, clearly there would be some element of us needing to increase our retail book. And that's one of the real advantages we have in having two brands. I mean, they're two different brands, Meridian, traditional, PowerShop, basically app-based, a different target market. We would most certainly be looking at increasing the overall size of our retail book. But hopefully, that planning can stay in the suitcase. All right. Neville.
Just one last question about the Australian wind farm revenue. What's the kind of level of hedging? Are you looking? Do you have PPAs yet? Looking at those, or should we think of that as being exposed to the spot prices?
No, we don't have PPAs at this point, but I mean, we have a market trading team in Australia that takes forward cover, and we have a policy, which Linda is actually a member of the committee, that looks at ensuring that we stay within our risk profile boundaries that have been approved by the board.
But the availability of PPAs at the moment is pretty
zero.
It's pretty much zero, yeah.
Any other questions here on the floor? No? Okay, well, we'll throw this open to anybody who's in the ether who would like to put a question forward. Great. Either no question.
Ladies and gentlemen on the audio, if you do have a question, please press 0 then 1 on your telephone keypad. That is 0 then 1. And we do have a question from Grant Swanepoel from Craig's Invest. Please go ahead.
Good afternoon, team.
Hello, Paul. Hello, Grant.
A couple of questions.
Grant, Paul and I had a bet whether you would be the first guy to pop up with a question, and looks like we were right.
Oh, I'm full of questions and shit. First question on growth. It was just we had the first up contact the other day, indicating that temperature played a very important role in a lot of that growth that we saw. And your commentary today indicates that actually there was something more there. Can you talk a bit about the commercial side of the growth, not just urban residential? And if there is any growth and you were planning to put another wind farm in place, what sort of long-run marginal cost do you have on your wind farms now, particularly with the currency having retraced somewhat? And on that front, if you aren't going to build wind farms for many years, on your cost-cutting side, is there much cost in you holding on to the talents and skills of your wind development team and design team on that front? That's the first question. I know it's a long one.
That wasn't one question, Grant.
Before you get on to the next one, maybe we
Yeah.
start with that one before we forget what you said.
Yeah. Why don't we just start with the question you had around the growth? I'll just comment on the temperature, and Paul can take the commercial growth. But that was my first question that I had to our analysts, Grant, was whether is this just really a temperature aberration? And the answer was that, on our analysis anyway, it definitively wasn't. So Paul, if you can just talk a bit about the commercial sales.
Look, it isn't very easy to get down under the covers of this data because it's all clouded by stuff like embedded generation, which isn't well reported on. So really, all you can say is it's in agribusiness. It's provincial New Zealand. It's happening in the same places as you would expect if it were to be driven by new dairy plants, additional irrigation, etc., etc. So it comes from the parts of the country you'd expect it to come from, given where investment is going into the agricultural sector. That was part one, wasn't it?
Yeah. So, Grant, the next part of it was around the wind farms. Can you just repeat that?
What would the long-run marginal cost be given current exchange rates if we were building one right now?
Right. Okay, well, this is going to be
There's a finger in the air,
This is going to be a little bit of a finger in the air, but I mean, I think we would be around about the $85 to $90
I think
range.
Look, we've got stuff that sits within quite a wide range, so it depends on what your assumptions are. There's stuff that goes into the high 70s up to the 90s, but we don't look at it against what today's exchange rate is. We look at long-run exchange rates when we think about that stuff, and with the sort of time that's going to elapse before anything's built, there will be further technology developments, I would have thought. So it's probably unsafe to
It's not something that we currently monitor, Grant, given the oversupply situation that we have. I mean, it's not something that we think we need to actually have a handle on for tomorrow. But, I mean, coming back to your point about the cost of maintaining a team, I mean, we are a company that is solely in renewables, so we have to keep a skill base in hydro and in wind, both in terms of maintaining it and being able to plan for the future, because, as I said in my speech, I mean, we still are developing our most current options, if you like, in case we do get blindsided by growth. And that's something that we just wouldn't be prepared to march into the future and then contract out to somebody else at some future point in time.
And it's worth remembering that that team also contains expertise that's deployed on existing assets. So there have been, for example, some significant improvement works that have occurred around West Wind, around high wind events, and the work for that came out of that team. So that team is not sitting on its hands or just concerning itself with trying to improve the option suite. It's also concerning itself with trying to improve the existing assets output.
Next question, Grant.
Thanks. The next one's a shorter. You mentioned that residential pricing should be flat over the next year, but the forward curve on the hedge market has picked up. Are you seeing a recovery in how you're selling forward on C&I? And the final question, just in terms of the VAS differentials, it looks as though you're making a gain on that contract again. Over time, you've indicated that's going to go to zero. When do we think that'll start moderating? Thanks.
Well,
the C&I pricing point, so we didn't say anything beyond June 2015 in terms of residential pricing, so that's the first thing to say. The C&I pricing is a little bit early to tell. You know, there's a limited flow of deals that come through, and I think we'll have to sort of watch a few months to see whether there's any movement. That price movement has really only started to show itself in the last 2 to 3 months. So I'm really cagey about whether that's going to happen quickly. But look, the history says that C&I pricing does track reasonably close to ASX plus a reasonably standard margin. So I'd expect it to turn up, but when is a bit difficult to say.
Just on the residential pricing, Grant, I mean, I got asked in the previous presentation to media about that, and I mean, to be clear, I mean, I said about a year ago that we saw no increases in prices of energy prices through to probably June 2015. That undoubtedly is going to be correct, but I am not going to give a commitment sort of past that date. I mean, we have got a number of networks that haven't had price increases since 2011, and we haven't put any network increases through since 2012. So I can't give a similar commitment.
Was that the last bit of the question?
That was the last piece, wasn't it, Grant? Paul?
No, it was on the VAS differential.
Oh, the VAS differential.
Yeah.
You try and model where it's going to go. It's not.
How do you figure that one out, Grant?
Don't really know. We expected to have already been sort of ebbing away, but look, within a couple of years would be my expectation.
Thanks, guys. That's it.
Any other questions?
Thank you. Yes, we do. Our next question is from Peter Wakeman. Please go ahead.
Greetings. Couple of questions. The first one is with regard to Australia. You say you don't really know what these renewable assets are worth potentially for development or not. Do you think there's any possibility of looking at going aggressively raising funds as a separate subsidiary in Australia and acquiring any sort of possibility of getting greater economies of scale and having a greater renewable energy book as opposed to just the ones that you already have on your books at the moment?
Peter, I think that would be very difficult in the current circumstances where, I mean, anybody looking at a development can't really get any fix on what the total energy price is going to be on day one, let alone in sort of make any assessment on where it is going to go over a 20-year period, because the government, as you might know, I mean, the energy price in Australia for renewables is made up of basically what they call the black price, which is just, you know, the traded price, the wholesale price, plus the value of LGCs, or large generation certificates, that are generated under the legislation. If the value of those goes to zero, then you won't see any renewables built in Australia for a very, very long time. And it's that uncertainty that's out there that means that nobody would be willing to invest in such a vehicle. I mean, we're not totally negative about Australia, by the way. I mean, Australia innately is a very strong economy. It doesn't sort of look at the moment, but I mean, it has a lot of natural resources that someday in the future people are going to want again, and in greater quantities. So, you know, we think the economy has inherent strength. We think we've got a good position in renewables, but it's going to take some time for people to get confidence back that they can invest in Australia and not have their position undermined by regulatory change.
And in respect of existing built assets and whether there are opportunities there, it really does look like everybody, again, is sitting on their hands, because it's a binary outcome. Do they see themselves in a position where there's a seriously distressed assets and they have to accept basically a black price value, or something a little above, or are they back to a position where those assets are worth the money that they paid for them in the first place? So you're not seeing a lot of movement in terms of asset owners. There's obviously a lot of investment bankers touting their wares about, but there's not a lot of movement from asset owners to realise these, whilst value is very uncertain.
I mean, and again,
Right.
we don't be overly negative about this. I mean, there might be a stalemate in Australia from a political point of view. The RET might stay there, and I mean, prices might stay at a very attractive level until at least there's another election. But we've got to look past one election cycle when you are looking at investing in assets that have a life of 20 to 25 years.
Right. The next question sort of perhaps concerns New Zealand probably more than Australia, because the compulsory savings system is not as much. And that is, first part of the question is, with regard to the inflation rate that governments measure, for example, in the UK, don't quote me on this, the inflation rate between, I think it was about 2007 and 2013, officially it was about 8%, but for retirees, their inflation rate allegedly was about 33%. So if you look at the people of the older generation who haven't got any extra income apart from the pension, do you see a drop-off in people being able to afford their bills? Like in Christchurch, I've seen people on low incomes wearing gloves and hats in their house because they simply cannot pay, and Christchurch has a very low income base when you compare it to, say, the likes of Auckland. So the inflation rate measurement, do you think there's any point in challenging the government on that, because it's not really a true indicator of rising costs? That's the first part of the question.
Well, should we just answer that one first? I mean, I take your point, but I would say that electricity prices are one area of the goods and services in that basket that does get a lot of commentary from the press. And in the case of Canterbury, as Paul or I mentioned, we haven't had an energy price increase actually since 2011. There have been, of course, increases for Orion's work that they had to do post the earthquake, and increases in the transmission costs. But from an energy point of view, I mean, prices haven't gone up, and I think it is one of those areas that does get a lot of political commentary. I don't think it's under the radar. It's not the same as the jar of Marmite.
Well, because you've got line charges and the emissions trading scheme and GST going from 12% to 15%, that's a 3.5% alone, just increasing GST. So the question really is, do you think with the legal decisions that happen when people want inflation rates, do you think the inflation rate is a true measure? So what I'm suggesting is that retirees are not getting an inflation rate pension. So is that going to affect the demand, and do you think the inflation rate is a true measure of actual costs?
Well, I think you're getting into some areas that are really quite political, and the sort of thing that an organisation like Greypower is probably more appropriate to take up. But I mean, in terms of the impact on us, I think we would say that the impact would be very slow and very gradual, although we do recognise the impact on people such as pensioners who are relying on largely fixed income from the government. But it's an issue really that has to be picked up by other groups other than, I think, Meridian.
And whether it changes whether it changes the picture for us really depends on whether any particular group gets larger or smaller as a percentage of the population, and that's quite a slow process.
Yeah, I just thought with the amount of people that are going to be retiring soon, you know, as opposed to working. But anyway, thank you very much for that.
I'm one of them, Peter. I've only got 7 years to go to get my gold card. Are there any other questions out there? Anybody watching the webcast?
And yes, we do. We do have another question from Chris Labert. Please go ahead.
Good morning, Mark. Morning, Paul. Just two questions. The first, just on guidance. You said there's no need to say any more. Is there any reason why you haven't popped the range that's in your documents and already disclosed in today's disclosures?
Well, as I say, we look at what we said at the AGM or ASM. And I mean, we look at what the disclosure obligations are around 5% either side, etc., having to start to look at it. And when we looked at it, we were happy with the number that was talked about at the ASM and feel it would be inappropriate for us to really make any other comment.
No problem. And just a quick one on the red. I know we've been discussing it a fair bit today. In your conversations in Canberra that I'm sure you're having, we're hearing that a target of around 33 terawatt hours, which is sort of a midpoint between the current target and a grandfathering of the existing fleet, is a likely outcome. Just wondering whether you have a different view to that as one of the likely or more likely outcomes at the moment. And I guess a second part to that question would just be if legislation were to be passed, say, in the next couple of months, are we to imagine from your previous comments today that that still wouldn't be enough to get you to invest further in Australia, or would you need to see that and something else to I guess incentivise you to invest?
Well, on the first one, I mean, yes, we've heard very similar sort of rumours, but I mean we've heard a lot of rumours over the last sort of 6 months, and from either side of the spectrum, right from a grandfathering through to it staying the same. But yes, we have heard that rumour, and we can't really give it any credence. You're right. I mean, the head of our Australian operations is a frequent traveller to Canberra and keeps a sort of a finger on the pulse. But, I mean, Australian politics are shifting sand, so I don't think we would put any reliance on any view at the moment. And, I mean, your next question is, well, if they did make a decision, would we invest? The answer to that, I guess, is if the numbers look right and we could get a PPA from a credible party that was at a number that gave us an economic return, and we were reasonably comfortable that there was a bipartisan approach to monkeying around with the RET or whatever might replace it, yes, we would look at it. But I'll go back to my comment. I mean, we innately see Australia as being a higher growth market than New Zealand over the long term.
Very useful. Thank you. Thank you very much. That's it from me.
Right. No other questions?
And on the audio, we have one final question from Stephen Hudson from Macquarie. Please go ahead.
Huddy.
Oh, good afternoon, guys. My questions are relatively prosaic against the previous ones, so it should be fairly painless. On your funding costs at the moment, I think you're running around about an average funding cost of about 8%, if I'm not mistaken.
No.
Against the context of you taking on re-gearing another sort of 625 million over the next 5 years, I was just interested in what your marginal funding cost is, and whether or not you would take the opportunity to perhaps refinance some of your existing book. That's the first question, maybe for Paul, and then maybe Mark, just on stay in business CapEx. I think you've kind of talked about 70 million going forward. You've obviously come in a little bit under that for the half, without wanting to read too much into 6 months of expenditure. Is that 70 million looking a little bit conservative, do you think, going forward?
Well, can I say this room, Stephen, is full of bankers, and the reason they're here is to lend us more money at negative margins. So other than that general comment, I'll pass that over to Paul for a better answer.
If you want the actual effective rate, just look at our year-end financial statements where it's actually in there and it's lower than 8. I can't remember the exact number, but it doesn't start with an 8. Yes, we would be expecting the marginal cost to be lower. Whether we take the opportunity to refinance, that's a reasonably finely balanced question, because remember, we've got a whole set of interest rate hedges across our book, across a forward profile. So you might be taking a bit of pain now for going down the track. We're going to be looking carefully at that as we assess our debt needs. But there are some opportunities to reduce overall debt cost if we remain in this environment.
And on the CapEx ones,
Paul, can you give us some colour for kind of what your current, funding costs are? Sort of, I don't know, 3 or 5 year kind of wholesale money. 3 or 5 year fixed money.
I haven't been out. We haven't been out for debt for 6 months or so. I haven't probed the market because we haven't had the need to. We generally will look when we need to look, but I could go away and have a look and come back, give you a call.
Very finely.
Off the top of my head, I'd probably get it wrong.
Stephen, very finely priced, I would imagine. Very finely priced.
It's a bargain basement.
Bargain basement deal. And these banks, of course, have got lots of liquidity, and they just are lining up to give it to us.
Nowhere to put it.
Nowhere to put it. Look, just on your CapEx question, I mean, I think the number that we talked about in the prospectus and talked about with investors were around about $65 million. And, I mean, we have had, obviously, the 3 Manapuri transformers come out of nowhere and get us this year. We're very confident that we're going to stay under that number. Stephen, we don't believe that we're going to have any cause to believe that we're going to spend more.
That 65 million was set by reference to a 15-year asset management plan view with an overlay of what you have to spend in the sort of ICT area on top of it. So at some point there might be the odd year which pops a bit above, but the average certainly would be below.
Should be below it.
Yeah.
Okay, excellent. Thanks, guys.
Thanks, Stephen. Okay, I think that was the last question. So with that, I'll just thank you all for attending, and we'll go and have a sandwich.
Excellent.
Thank you very much.
Are the sandwiches coming?
I'm not sure.